Hello, everyone. My name is Adam Davis, and welcome to episode 6 of the 11FS Newsroom. In this weekly show, we take a deep dive into the biggest news story of the week just gone. Don't forget to give us a follow on LinkedIn so you never miss an episode. Also, in case you missed it, and before we dive into the detail, our new report, which is called Better Banking Business Models, embedded finance and the path to growth, is a must read for banks considering their smartest next step. Head to bit.ly/banking as a service to download the report for free. That's bit.ly/banking as a service, all one word and all lowercase. Cool. Today we're talking about the big banks' Q3 results, which have just been published over the last 10 days or so. On first look, the results are relatively positive and relatively promising, but there's a lot to unpack and probably a lot bubbling underneath the surface. We're not going to read out all the numbers to save you, but we are going to bring out a couple. So just to put it into context, NatWest reported last year in Q3 an 8 million loss. This year in Q3, they expected to post a £75 million loss. It actually posted a profit of 355 million. Barclays forecasted a Q3 profit of around 200 million. That was by analysts. Final results were in at 610 million. HSBC called part of its performance not acceptable, and their profits have gone down 36% from this time last year. But still generated 3.1 billion profits after tax. But remember the size and scale of HSBC, we're talking the global bank. Lloyds has lent over 11 billion to over 285,000 businesses under the COVID support schemes and provided 1.2 million payment holidays to consumers, like staggering numbers. Out of these, 80% of customers are now repaying, which might surprise some. Might not stay at that level, which we'll discuss in a sec, but might surprise some. To dig into this, we're joined by someone who has followed the results closely and a friend of Fintech Insiders, Emily Nicole, Fintech correspondent at Financial News. How are you doing?
Hi, I'm good, thanks. How are you?
Yeah, not too bad. I understand you've got sort of a plethora of issues going on with Wi-Fi's and heating and kids coming outside. So, we'll roll with it. Hopefully everything will be fine. But how are you doing? You're not too cold?
No, I'm good. I'm all wrapped up and I've turned the heating up, so ready to go.
All right, cool. That's the important thing. All right, nice. Look, as always, we love getting your questions. Leave them in the comments sidebar and we'll answer them as they come in live on the show. Just as a little bit of a background to yourself, Emily, I'm sure most people probably know you who are tuning in today, but if not, what do you do and what do you cover and what are you interested in?
So I'm the Fintech correspondent at Financial News. We are a London-based weekly paper focusing on financial services. Mostly we cover the biggest banks, as well as other stuff. And then for me personally, I do, Monzo, Revolut, all the good ones, doing Fintech as well.
Set your stool out.
Starling's included that too, don't worry. And yeah, so today, for example, is really hectic. We're prepping for tomorrow's election coverage. So
yes, of course. So thank you very much for joining us because I know it's not the quietest day. Just a quick, in terms of the UK results, how closely have you been following it? And I guess, is there anything that specifically stood out for you, sort of as an overarching theme?
I mean, yeah, so pretty closely we're following it. Obviously we cover most of them, at least the biggest ones. So Barclays and HSBC, we did quite a few stories on that over the course of the last 10 days or so. Probably, the thing that stood out is what everybody's thinking is that none of us expected a Q3 quite like this one, and that's what we got. We didn't think pretty much any bank was going to report a profit because we had two pretty down quarters in Q1 and Q2. So having a standout Q3 was quite a nice surprise, especially given that GDP didn't do that either. GDP was down in the third quarter when we all thought it would go up thanks to retail help out. So the fact that banks outperformed was really quite surprising.
Yeah, and I guess one of the underlying reasons for this, I suppose, if you look at the results and the general consensus coming out of the banks, is that the COVID provisions in Q3 were way down on projections and certainly way down from Q2. And I guess that's kind of the underbelly that we might as well bring it up, up front. How surprising was it that banks had decided to only, I suppose, put a portion of what they'd previously allocated to COVID positioning and sort of and covering their potential default rates on some of the C bills and the B bills that they've already lent. And I guess from your perspective, do you see that as a continuing theme throughout the next sort of 2 quarters, let's say, or actually do you think it's going to peak back up and they were just doing it almost because there's a bit of a lull?
Yeah, I mean, I don't think anybody really expected the drop in loan provisions, especially analysts. They were all very surprised when it happened. I think everybody had kind of forecast at least double, if not triple, the amount of provisioning that happened from most of the big banks. And it wasn't just the UK either. A lot of the Wall Street banks also reduced their loan provisions quite drastically. So there was obviously some kind of secret meeting that none of us knew about where they all decided we're not going to do it this quarter.
Mate, this is wonderful, Emily. This is brilliant. This is exactly where we wanted this to go. The conspiracy theory.
Yeah, exactly. I'm conspiracy theory. Well, basically, analysts weren't kept in the loop, so it was very surprising for everyone. But I'm not exactly sure why they would have done it, because, I mean, we didn't necessarily have the economic data to back up the fact that things were going well. So they're obviously seeing some kind of early,
and we've got a question mark. And when you're back.
I'm back.
Yep,
back. And I'm back. I was saying, so they might be seeing some early returns from those loans that they haven't yet reported, that maybe made them more confident, or something's happening even globally, actually, if Wall Street's also doing the same thing.
Well, I mean, I mean, the Lloyd's level of repayment at 80%, that massively surprised. I was like, wow, that's a significantly higher number than I would have predicted maybe a couple of months ago. And certainly if you're an avid reader of the broadsheets on the weekends, you'd probably be hearing doom and gloom about everyone's just sort of taking the money and running off with it. So, I mean, how surprised are you with that kind of statistic, that actually businesses are able, if you like, to pay back or start repaying back the C bills or the B bills that they've received? And I suppose, what's your confidence level, being someone who looks at this on a daily basis? What's your confidence level that that will actually continue into next year?
I mean, those numbers from Lloyd's are certainly positive, and I think, at least we see from the media anyway, that a lot of businesses are still crying out for those provisions to continue. And so now they've announced that we will be able to apply for at least one top up, per business for all of those loan schemes. So that lending is set to continue as well, which is probably a nice boon for the banks. But whether or not they think that they're going to be able to continue keeping those loan provisions where they are in Q4 is going to change drastically with how lockdown goes, I guess.
Yeah, of course. Well, that's just it. There's so much. I guess there's just so much uncertainty, and at the beginning of, we're really at the beginning of a process where the majority of the loans that have been lent are obviously on incredibly low interest rates, and actually don't have sort of any interest payments required for a certain period of time. Majority of them a year. So really, you're sort of looking at, I guess, next June, July, thinking back to this summer as the time when pandemonium might hit, and that 80% might come down, significantly. But just on this, in terms of the repercussions of the results at a high level, looking at this table, which
the spread they've gotten out of Q3, it's a lot more positive overall and optimistic than anyone was expecting. So it makes sense that the shares would lean towards the positive, even if it's not that much of a gain. It's actually surprising that HSBC is up there with the highest gain, given that it was the only one that didn't report a rise in profit. It fell. Yes. But I think that also might be to do with the fact that a lot of the banks, at least those with significant markets divisions, did very well out of the most recent big bump in volatility and being able to trade stocks. And I mean, Barclays did fantastically with its division in terms of it. I think its sales and trading business is on track to have its best year ever, I think, so far. So
yes, it looks like again, an overarching theme of a lot of what we've seen is that the IB departments, equity departments, even have boomed, if you like, over the past 9 months, and have, as you say, have sort of been supporting the rest of the businesses. Consumer retail revenue is significantly down, and on the, I guess, the consumer banks or the retail banks who have seen, I think it was RBS was down around 12% this year, this quarter, versus last year, where they actually made a loss last year as well. I mean, if you look at that in particular, and you look at interest rates staying sort of where they are at the moment, NIM compression, which is net interest margin, which is traditionally how banks make money. I mean, and of most probably a higher default rate going into next year. How worried should banks be in terms of sustaining, I suppose, profit margins, or sustaining any sort of margins in their retail business in particular?
I mean, so yeah, the threat is kind of permanently hanging over not even just interest rates staying the same, but also turning negative. I think globally, regulators are almost testing the waters for whether or not things could happen. I know that at least the Bank of England has asked firms here whether or not they are prepared for a negative interest rate environment and what they would do if that happens. We've had some kind of expectation from investors about what they think could happen with banks. I know at least the team over at Goldman Sachs did some forecasting on what might happen to NatWest if there was a negative interest rate, and they expected probably about a 450 million hit over the next 3 years to that interest margin.
Wow.
So it's not going to be good if that does happen for banks, but I'm not necessarily going to say that, yes, that means, for example, they might need to start doing things like charging for products or that used to be free, or just completely revisiting their business model. I think in the last year or so, it's definitely been proven that all of the banks are in flux. Cost cuts are everywhere. They're all changing their structures. So the fact that this has now happened isn't necessarily going to derail them from that journey. It might mean that they ramp up some of those costs a bit earlier than they thought they might, but it's everyone's in change, and everyone's trying to learn how they can do business in 2020. So
I mean, you say you don't think banks should, let's say, start charging for current accounts, but one of the noises coming out of HSBC was that they were looking at doing exactly that. Not for all their current accounts, I should add, not for the most basic account provision that they provide. That was going to stay free, but the tier above that, they were looking to charge, or looking at starting to introduce sort of a tiered model. I suppose. I guess, I mean, I tweeted about this when I first heard about it. Across the last sort of 5 years, whenever I've worked in a bank, and the prospect of potentially charging for a current account has sort of come up as an obvious source of revenue. And then you get into things like, not I should say packaged, but the packaged current account and whatever, and how can you actually deliver value for customers for the money that they would pay. Generally, it's always been really badly received by customers and by the public. It seems like because of Monzo and because of Revolut and because of all the fintechs who almost exclusively take a tiered approach to current account provision, it's almost, certainly within our sort of fintech bubble, if you like, it's almost become something which doesn't really have that same sort of oh my god, they're going to cheat everyone out of money kind of a reaction to it. And I suppose in that respect, do you think that almost charging for a current account has become normalized, and therefore should HSBC do it? Let's put aside the results, but actually, as a potential revenue stream, because it's not as it's probably not as derived maybe as it once was.
I mean, so I don't think that all banks should be charging for current accounts. I mean, so HSBC have said, yeah, they're considering it, but then NatWest, Alison Rose said it's not on their plans for any period, or at least not in the future that they can see. They don't plan to start charging for accounts.
Oh, and Emily's gone again.
And
and Emily's
back.
back again. This is fine.
It's
like the bounce. It's like the bounce. You're bouncing back. It's not a problem. It's very in theme with the show.
NatWest, for example, said they're not going to do it. I am actually personally one of those skeptics about charging for accounts now. I know you think that the fact that Monzo and Revolut have launched these tiered current accounts, maybe there's more of an appetite for it. But I personally don't think that it's. We've seen before with several versions of these premium accounts from fintechs that actually take up is rather minimal compared to their overall user base. And Monzo has tried several times at launching premium paid for accounts and retracted them several times or updated them several times. So I think actually there's more evidence to suggest that it's a very difficult thing to do, to start asking customers to pay for it. And if you're going in at the ground level and saying, here's your standard current account, you're going to have to pay for it now, I don't think it's going to go down overly well.
Yes.
But then also at the same time, we're used to receiving products that cost money from banks like HSBC, Barclays, Lloyds, NatWest. We're used to having to pay maybe a little fee here and there for the credit cards or something to do with your mortgage or whatever. So maybe those customers will actually be more inclined to accept fee charging products if it changes, because they are used to having to do that. Whereas with fintechs, we're used to getting everything for free.
Yeah. I mean, and just talking about one of those fee charging products as well, just focusing a little bit on mortgages. We're sort of doing the full array of different banking products here, but that's what Results Day is all about. Mortgages is really interesting because if you look at Lloyd's loan book in Q3, it went up by about 3.5 billion, which is an extraordinary amount, but just on mortgages, that is. I think it was the RIBS have said that mortgages at the moment is at an all-time high. House prices is just topped all-time high, and this is from obviously an enormous lull during Q2. So spurred on by the Chancellor's stamp duty exemption, and spurred on by obviously the lull in Q2, which means nobody could move house, and then obviously a lot of those houses, then the offer's going through, it's being completed, and then looking to exchange. Do you see that because this is becoming, so important to a bank's balance sheet and lending book, do you see the chance of potentially extending the stamp duty exemption? And if they did, what kind of effect would that have, I guess, on banks' loans books going into next year? I'm thinking more Q3, Q4 next year. How important is it going to be?
I mean, it feels more, if you was to extend stamp duty, it would feel more like it was providing some kind of support to the banks and providing some kind of support to the property market, because mostly we've seen.
And Emily's gone again. Third time's a charm.
And I'm back.
Just roll into it straight.
The problems with Wi-Fi these days. So mostly we've seen so far that the UK community anyway bounced back pretty quickly from, like you said, the lull in Q2 to then being able to move and close deals in Q3. So it's not necessarily that the demand isn't there for moving house. And some of that might have come from stamp duty, but also you have to kind of factor in as well. House prices are also really low at the moment. Mortgage holiday period has also just been extended, the deadline on that. So there are lots of other reasons why people might be moving house, and rather than just taking advantage of stamp duty not being there at the moment. Whereas for banks, because interest rates are low at the moment and could go even lower, the mortgage section is really a boon for them. They really need that right now in order to be able to keep going, keep bringing in some money, especially for those that don't have things like markets divisions where they can make some bumper revenues off the stock market. So it would almost feel like if Rishi did choose to extend the stamp duty cut, that would be more of a business decision for the banks themselves rather than for the wider community.
Yeah, it is interesting that that reliance on I suppose investment banking revenues is, I know we touched on it earlier on in the show, but it is so interesting, especially if you look at I guess the strategy of, let's say, a NatWest across the last maybe 5-10 years, maybe to exit their markets business or certainly scale it down significantly. And you look at just how important Barclays US operations has been, which is predominantly IB based, and the contribution that the investment banks have made to HSBC. Is it now a case that banks maybe got scared about ring fencing and off the back of the 2008 crash and sort of went into hyperdrive in terms of closing down their markets divisions, but actually, or certainly de-risking their markets divisions. But actually now going forward, just given where we are from an interest rate perspective, is the time now to actually plow back into it and scale it back up. And I'd be interested specifically, I mean, I'm asking a relatively leading question, but if you look at like NatWest as the example, who obviously is probably the biggest example of a bank who has significantly scaled down and been very public about it, do you think that's going to continue to be the right strategy given the results that we've seen?
Yeah, I mean, I wouldn't necessarily say that the banks should then start doing almost a U-turn on their market divisions and start plowing more money in, because I think all this has proven is that any revenue they've got from anywhere kind of needs to be safeguarded with it under lock and key and make sure that everything's doing well. There's still a lot of cost cutting going on across the whole sector. But I do think that it is going to prevent others who haven't yet done that turn or have maybe only just started thinking about what they might do with their market.
Ah, she's got it again for the 4th time. And we're hoping for a bounce back. And we've got one.
This is not good. They're probably not going to be getting rid of it anytime soon. So, for example, Barclays is really a big one for whether or not they're going to get rid of their markets division, because of their largest shareholder, Edward Branson's been pushing for getting rid of the markets division for a long, long time. And he was almost close to getting his way, but then Q3 has pretty much put that out of the market for any time soon. I mean, the trading division at Barclays is really its saving grace. So, and just with the way that coronavirus has really affected markets these days, it doesn't look like it's going to go anywhere anytime soon. So,
cool. We've got a question that's come in from the great Ali Patterson. Hi, Ali. I hope you are well. Do you reckon we will hit negative VE rates, negative interest rates? What's your view on it? And actually, an interesting question off the back of that is that if we did, could you explain slightly in terms of what that would mean to, let's say your loan, or any loan that you would, or your savings, or any loan that you were looking to take out from the bank?
Yeah, I mean, I'm not an economist. I'm going to put that out there now.
So don't do that then. Let's concentrate on the first bit of the question.
Yeah, the first bit of the question, do I think it will happen? I think the fact that the Bank of England has had to be quite public about that it's asking banks and firms, what are your preparedness for negative interest rates? What plans do you have in store? We need to see those plans. We need to know what you're thinking and what the impact to your business would be if we did this. I think that's enough of a sign that it is possible. It's on the table. It's not going to happen soon. We've got the Monetary Policy Committee meeting happening Thursday, and that's obviously largely going to be about quantitative easing. But we're not going to see any negative interest rates immediately. But especially with now us heading into a second wave of lockdown, we're not too sure what's going to happen with Christmas. GDP is probably in for a massive hit, at least in November, but there's also now a decline being forecast for Q4. Negative interest rates are definitely on the horizon. So.
And then into how bleak, I mean, I don't want to turn this into the most depressing podcast ever, but how bleak is your outlook for sort of let's say next summer? And I'm specifically thinking when some of the initial loans, the 1 year period, that sort of interest-free period elapses, and businesses actually need to start paying back. In theory, if you listen to the headlines, Corona might be on its way out. We might have a vaccine by then. It might be sort of mass produced, which would be great. But taking that into consideration, but then also taking into consideration just the sheer scale of how much the government has given via banks to the public and to businesses. Like if you could sum it up in like a sentence about how fearful you are for next summer, how bleak would it be? Oh, it's that bleak. It's so bleak. She's had to leave for the 5th time.
And I'm back.
No, I was going to say, it's so bad.
Right,
it's so bad you didn't want to answer the question.
Next summer. I'd say I'm probably about like 50-50 on that, because I do think it's entirely based on whether or not we get a vaccine. Current forecasts are that we might have a vaccine in place by the end of the year, at least one somewhere in the world anyway. And it's up to the government on how they then distribute that vaccine. Jeremy Hunt wants everybody getting tested for coronavirus once a week in this country at the beginning of next year, which does seem a bit much, especially given that we don't even have a test and trace scheme that is achieving what it needs to at the moment. So if the vaccine stuff can get on track the way it should do, then maybe by summer we might have businesses in earning enough money that they can make those repayments on time. But if we're still in a state where business like footfall is down on the high street, businesses are still having to do maybe short circuit breakers once every 3 months, that kind of stuff, then it's not going to be looking good for repayments happening then. And if it's that widespread, the government might have to think about maybe delaying that first repayment date.
Yeah, I mean, it is interesting at what level analysts probably expect the bank's COVID provisions to go up to. So, I mean, RBS said it would be at the low end of, let's say, the 3.5 billion range, and they've pretty much put that aside. I think all the UK banks are similar. That the US banks are sort of putting around double, some triple that amount for the US economy. But it'd be interesting to see whether how they fluctuate. I think Jamie Dimon came out, the JPM head, and said that it could actually top 20 billion in the States if things go significantly badly. But it'll be interesting to keep a view on that throughout the results. Bringing it back to the banks very quickly, we're going to try another table. Looking at this table, oh yes, this is magic. Looking at this table, this is the return of investments, or what you would have got as a return if you'd invested into the banking sector at the beginning of last year, so 2019. And this really tells, like, I guess from your perspective, looking at that, if you're an investor, why would you put your money in banks right now? Like, I think there's I know Lloyds and Barclays are two of the highest traded companies on the FTSE at the moment. They're always in the top 30. I think Lloyds is generally in the top 10. But I mean, looking at that percentage change, I mean, and looking obviously at the percentage change of, let's say, the tech sector and other sector who potentially are a little bit more, I wouldn't say recession proof, but maybe COVID proof. Why would you put your money in the banking sector? And is there any sort of ray of hope over the next 18 months that this kind of, I suppose, pattern can be corrected? Probably not by what we said, but.
I mean, I think looking at this table, it kind of shows you that investors have been.
Oh, I'm going to finish her sentence off for her. I'd say investments have been spooked.
Oh my God. Sorry, I think it's going to happen every few minutes now, so everybody watching is just going to have to be okay with it. I think the table shows that investors have been nervous about backing banks, at least in public markets, for a while. And you're right that something like the tech sector, for example, is considered more COVID-proof or recession-proof. But London also doesn't really have much of a tech sector in its stock market. Most of the big tech-proof stocks are abroad. So it's more, so banks usually do a bit better in London because of that. They usually have a bit more to play with. They're they're among the biggest stocks that we have in the FTSE 100. That said, though, I think most investors are just very aware that banks on the whole have not been having a good time financially for a while. We've seen most of Europe's top banks have launched big cost-cutting programs, and coronavirus is now throwing a big spanner in the works as well. And even with a positive Q3, we're not even really seeing much momentum for banks returning to growth. It's kind of a bit like, well, we had a good blip, but Q1 and Q2 were pretty terrible, and Q4 is not likely to behave like Q3 did either. Yeah. I think even the chief executives have said, we don't think that Q2 was not an anomaly. Q3 might be an anomaly, but Q4 is unknown. So whether or not banks are a safe place to put your money, I mean, I'm not an investor analyst, don't take my word for it. But I wouldn't have said that this previous history of how their share prices performed in the last year would make anybody feel confident about using that as a place to put their money, especially during a recession.
Yeah, fair play. One more question really that I wanted to ask you, which was around, given these banks' results and given obviously some of the overarching trends that we've discussed today, if you look at the fintech sector, so the challenger bank sector, so referencing Monzo and Starling and Revolut and others, how obviously none of those guys are public, so their results come out once a year and you can see them, etc. But how do you think they'll be feeling right now, and will they be feeling similar issues as the big banks? Probably not from a COVID provision perspective, but in terms of general operations and reductions in revenue, etc.
Yeah, I mean, I think we've seen a pretty mixed bag, right? So Monzo was infamously not doing so well, at least at predicting what the next 12 months were going to be like for them, especially if the coronavirus pandemic continues. But then Starling, for example, on the other hand, was saying, oh, well, we expect to at least break even by the end of 2020 and be profitable in 2021. So, I mean, it's really a mixed bag for fintech at least. But I think if you look at those that aren't necessarily banks, but are just fintech firms, so the likes of TransferWise and other groups, people have been able to raise money.
For the 6th time, she will bounce back, is my prediction. She's back.
I'm back. So the venture capital community has been very, very open with backing startups still, even throughout this year. It's obviously not going to be like the record amounts that we saw in 2018. I think those are probably a while off returning now, given that 2019 didn't perform that way either. But at least privately, big investors with big checks are happy to back fintech firms for the future. And if anything, fintech firms there, especially those that do things like software as a service and banking as a service, are really probably going to benefit from this need for bigger banks like HSBC and Lloyds and everyone to use this time to transform. There was a report by the World Bank last week, I think it was, that said regulators are still prioritizing fintech this year, even in the context of all this, and fintech is still considered a very big thing that needs to be protected and worked on, and central banks are also in that. They're the most likely fintech financial regulator to think about prioritizing fintech at the moment. So that in mind, it definitely points towards the fact that even if their overall results are low and these big banks aren't able to perform the way they want to, it doesn't mean that it's not a time for transformation still. And that's where fintech will benefit.
Cool. Emily, thank you so much for joining us.
Well, sporadically joining, yeah.
Sporadically joining. It's always great to have you on. I think I did my first ever Fintech Insider podcast with you. There's a bit of complete trivia for those who are listening. But yeah, it's amazing. Thanks again, much appreciated. And to everybody else, it's come to the end of the show. Emily, where can people find out more about you? Because I know at Financial News, but what's the best way? Is it LinkedIn? Is it Twitter?
Yeah. So I'm really only on Twitter. I do have LinkedIn, but I barely use it. So at Emily J. Nicole is my Twitter feed. And you can also read all our stories on fnlondon.com. Or if you're working for a big bank, you probably get our paper every Monday as well. So
cool.
If you're in the office, that is.
Yeah, quite. Right. And that's all we have for you this week. Again, Emily, thanks so much. Don't miss our other show, which is called Spotlight, which goes live at Thursday at 3:30 p.m. BST or 10:30 a.m. ET this week. We're joined by Lord Ed Varsey, which should be really cool, the former UK Culture and Digital Minister. So make sure you check that one out. Otherwise, have a great week, everyone, and thanks very much.